Hi, I'm Bill Cannon, Head of Portfolio Management at Valkyrie Investments, and here's this week's market summary. Updated consumer price index data was released Tuesday morning and surprised investors with higher than surveyed inflationary indications. This all but certified a 75 basis point move at the FOMC meeting. CPI declined to 8.3% from 8.5%, notably higher than the expected 8%, but within the surveyed range of 7.9 to 8.3%. Core CPI, which excludes energy and food, rose higher than expected to 6.3% from 5.9%, with expectations being at 6.1%. Month-over-month CPI rose 0.1% from last month, again higher than survey, which was indicating a decline of negative 0.1%. PPI will be released tomorrow with similar surveyed expectations of trending lower or unchanged, but investors will definitely be more cautious after today. Investors took CPI news hard and equity markets dropped immediately, with the S&P 500 declining over 100 points by midday. This follows a positive shortened holiday week, with the index rising to the 4,100 level Monday, then shooting down to 4,000 this morning. Interest rates moved higher, with the 10-year Treasury jumping to the 3.45% level after being range-bound last week near the 3.3% level. Front end of the yield curve has already risen 10 to 20 basis points from yesterday, with moves closer to 40 basis points higher from last week. Back end of the curve had more subtle move of 10 basis points, mainly from today's activity. Unfortunately, the 2-10 Treasury yield spread dove deeper into more recessionary indicative territory. The spread is currently approaching a negative 35 basis point level after improving for much of the month. CPI data will reverberate through world markets as growth expectations will tighten, especially in Europe, where the European Central Bank just raised rates last week. Inflation indications are comparably worse and could see a much more aggressive stance to bring down to more comfortable levels. Here in the US, while inflation remains a stubborn issue to deal with, the labor market and corporate balance sheets remain somewhat resilient, which could drive the Fed to a more prolonged rate hike strategy than desired. Investors may have to brace for more volatility, especially with midterms quickly approaching. Please let me know your comments and suggestions, and don't forget to subscribe. Stay nimble this week. Lots going on. Take care.